All right, well, good morning, everybody. I appreciate you all taking the time to be here. As Rick mentioned, we're going to change topics up a little bit. I want to go through just kind of my agenda. I want to take a few minutes to introduce our firm, who we are, kind of why I'm here, and then hopefully kind of get into some other topics around financial planning and some financial strategy that hopefully you can use as a framework to maybe apply to your own wealth management or financial planning needs and help you understand the purpose behind some main categories that hopefully can help you grow personally and professionally as it relates to your money. At the end of this, I'm going to have time, hopefully, for a couple of questions, and then I also found out I need to allocate a couple of minutes to practice some putting, so we can hopefully drain a couple of those. Not the best golfer, so I probably need to practice. So to kind of dive right in, a little bit about our firm, SignatureFD. We're 100% independently owned, so that's something I always like to kind of focus on. We don't have any institutional or outside money. It's just me and several other partners kind of driving what's important and where we want to go as a firm. We have, depending on the day, about $10 billion in assets under management, which I think is really an accomplishment given our organic growth and not having acquired things. The way we've been able to accumulate that level of assets under management is by specializing in two main areas. One being working with individuals and families that are kind of executives, equity compensated, highly compensated individuals, but also focusing on business owners and entrepreneurs. A lot of those tend to be in the medical field. We're industry agnostic, whether it's an HVAC company, a concrete company, medical practice, oral surgery practice. They all kind of tend to run into some of the same planning situations and needs. We've developed some specialization around that, which has kind of helped us grow to that level. So that's just the high-level commercial about SignatureFD. Now I kind of want to dive into some of the topics. Before we get into financial planning, there's a few kind of foundational things I always like to touch on. First being, everyone's plan is different. Everyone's goals are different. Everyone's time horizons, risk objectives, all of that is always different. So it doesn't make any sense to try and have some out-of-the-box white label plan that one size fits all. And I think to illustrate that the best and why we're all different, I like to go to this quote. We're not moving. So as we're figuring out how to move the slides up here, I'll just tell you the quote. Okay, so I just need it. So, oh yeah, sure. So, quote, your earliest experiences in life with or without money will directly impact what you're willing to do with and for money in the future. Okay, so everyone has different ideas about what money is designed for, what utility you're trying to get out of it, and a lot of those beliefs you have as an adult or a professional are rooted in your earliest experiences with or without it growing up. And so when you get to a point like you are, maybe a professional that has excess capital, maybe you're saving money, maybe you sold a practice, and you have money to invest or to plan with, a lot of those philosophies and feelings are going to directly impact, thank you, what you're willing to do with that capital. Perfect, there's the quote. And so when we're thinking about that, it helps us drive our framework. And so when we talk about wealth, there's really only four things you can do with wealth, right? You can grow it, which is fairly intuitive, invest it. You can protect it, which is protection of property, assets, legacy, anything that could derail a financial plan. You can give wealth away, right? That's either voluntarily or involuntarily. Involuntary giving is a fancy word for taxes. We want to manage that as much as we can, so we're all at least a little bit charitable to the IRS. And then there's voluntary giving, which is charitable organizations, that's families, that's communities, if you have excess capital, excess money to be able to make an impact that's important to you. And the last thing you can do with wealth is you can live it. That's the fun part. You can spend it. You can focus on cash flow, make sure you understand how much money you have to live a lifestyle that's fulfilling and accomplishing everything that you want to do. So I want to dive into a couple of those areas. So this picture, this chart, I think gives us a good visualization about where wealth sits and how those four main categories are interconnected. So I've mentioned wealth several times. What I also like to do before we dive deeper is really define wealth. And so I think a lot of people think of wealth as just money or just assets, but it's definitely more than that. It's your time, it's your influence, it's your money, it's your energy, and it's your relationships. And those, I think, fully encompass true wealth. So obviously time is an asset that we all have. It's all diminishing. We don't know how much of it we have, which can make it very important to plan for how to best utilize that into the future. Influence, your ability to kind of help with decision making and be powerful and persuade people is valuable. Obviously money, property, assets are part of your wealth. Energy, all right, that's your health. We do all this planning, we accumulate all of these assets, we do all these things. If you don't have the energy or health to enjoy them or be able to use them, the value of it diminishes greatly. And the last part of wealth is relationships. And using your wealth and the other elements of this wealth to make an impact on relationships that are important to you, right? So that can be family relationships, that can be business relationships, community relationships, religious relationships, and how you want to use your wealth to either impact with time, talent, or treasure on those relationships that are important to you. And this breaks each one of those categories out. So when we look at those four main categories about what you can do with wealth, three of them are kind of focused on self, right? Growth of your assets, protection of your assets or your family or your legacy, lifestyle spending of what you want to have done. But then also focusing on the give component of wealth, which focuses on others and is others focused. So giving to causes or family, either while you're alive or posthumously with appropriate beneficiaries and whatnot, as well as taxes, which are involuntary giving. So what I want to do is I want to dive a little bit deeper into each one of those four categories and kind of talk about some things that are somewhat unique there. So let me make sure this is... All right, I'm pushing the wrong buttons here. I apologize, guys. So I'll, if we could, yeah, it's back and forth. It's all right. I can go. So the slide that we can't see, that only I can see, is about growing. All right. So growth of investment, growth of capital. It's very important. It's probably the most intuitive element of wealth planning. And so typically over time, most professionals like yourselves, business owners, business sellers, are going to have excess capital that you can save and invest. Usually a portion of that needs to be allocated towards growth. And I think the big thing that I always like to focus on is growth has to have a purpose, right? It can't just be, I want to invest this and I need to earn 15% because 15% sounds like a nice round number and that's where I need to be. That's not going to allow you to stay invested in a strategy, thank you, or along the path that you need to be on. Growth with purpose allows you to focus on the reason why you're growing. So you're growing so that you can live or give more in the future, right? You want to have more money in the future so you can spend more money on trips, houses, travel, give money to charitable causes like, for example, the Face-to-Face Foundation, so you can be more charitable, make a bigger impact that you want. And once you have that purpose around why you're growing, it allows you to stick with the strategy. Historically, investments in equity, that's publicly traded stocks, privately traded or privately owned businesses, or private ownership of a private business have been the growth engine of value creation of growth. So that's something worth focusing on, but also understanding there is going to be risk, and that risk has to be something you're willing to accept. There are going to be natural ebbs and flows in any market, whether it's a publicly traded market or if it's a privately traded market with valuations. That's something you have to accept. And with an appropriately built financial plan, you will be able to stay the course even during the downtimes once you've accepted that risk. The biggest risk in equity market investing is not that the market could go down. I can't use the word guarantee a lot, but if you're investing in the stock market long enough, I can almost guarantee you're going to have a down year at some point. The biggest risk is that while the market's down, you're going to do something that's difficult to recover from in the future, like panicking and having a knee-jerk reaction to selling and getting very defensive at the exact wrong time. It's very hard to recover from that long term. So if you flash back to COVID 2020, the end of March, if you're out of the market for 1 week at the end of March, you missed the bounce off the bottom of the stock market. You missed about a 10% upward move from the bottom. It's 1,000 basis points. The only way you make up that gap is by getting increasingly more risky and aggressive, which sometimes is like flopping around in quicksand. That doesn't always work, and you can compound problems. So do your best not to interrupt the compounding of your wealth while it's growing. This chart is one I love showing. I know the numbers are probably pretty small, and I'm not going to touch the computer because I think that's the problem, user error. So I'll just turn around. Apologies if my back's to you. But this chart shows the long-term power of investing in the equity markets as measured by the S&P 500. So just to explain this chart a little bit, the vertical axis is the number of years. So 1 through 32, I believe, and the top axis are calendar years. So it goes from 1993 all the way to 2024. And what this is illustrating is that if, for example, in the top left corner, if you invested January 1st of 1993, your first year average annualized rate of return would be 10%. At year 6, your average annualized rate of return would have been 22%. If you remained invested, didn't add any money, didn't withdraw any money, so on and so forth. So if you stayed invested in the S&P 500 from January 1st to 1993, all the way through 32 years, your average annualized rate of return would have been 11%. All right, you see that number has gone up and gone down over time, but still, on average, a high number. And you just look further out. So this just shows and illustrates the power of long-term investing and staying in the market. So a couple periods of time I always like to point out. About the exact worst time you could have allocated money to the equity markets is January of 2000. So that was the beginning of what we call the lost decade. So you're basically buying into the top of the dot-com bubble, writing that down, recovering just in time for the great financial crisis in 2008 for that downturn. And then by year 10, if you invested in 2000, by year 10, your average annualized rate of return was still -1. And that's painful, right? You know, you've had your money invested for a decade, it's not growing, it's actually slightly negative. Caused people to make a lot of bad decisions. However, if you remained invested that entire time, didn't take any money out, right here, 8%. Your average annualized rate of return today would be 8% if you stuck it out. Other periods of time that are also interesting, 2008. If you invested in 2008, your first year was not fun. -37%. I get it, that doesn't feel good. But if you stayed invested, didn't take any money, didn't change your investment, today your average annualized rate of return would be 11%. 11% rates of return typically are going to get you where you need to go. So it's very important. It's not about timing the market, it's about time in the market. And I think this chart, it's busy, it does a great job of explaining that. Also, the reason those top boxes are grayed out, it just kind of shows you that after 5 years, it is very unlikely that you're going to have a negative average rate of return. So when you invest in growth capital, when you allocate to risk assets, you have to also allocate time for those assets to work. Speaking of growth, a couple tips for practice owners that I always like to bring up as we're talking about growth. Always set clear objectives and know your value drivers of the business. That's always going to help you grow. Knowing your business well, knowing what's driving value, knowing what's hitting the bottom line, and how to enhance or supplement those value drivers, very important. Build a team. You know, if you're a business owner, practice owner, medical professional, make sure that you have the right team at the office, but also the right professional team advising you around strategy with taxes, business law, as well as financials around potentially a retirement plan. One of the other areas, this middle one, take advantage of retirement plans. In my work with business owners and entrepreneurs, this is probably the biggest opportunity available to most people and most practices. They're not effectively utilizing retirement plans that are available to them. They may have a SEP IRA plan or a simple IRA plan or a very basic 401k plan that set up once, set it and forget it, and it is working, so it's not bad. But in most cases, after you've grown, maybe you have a couple of physicians, maybe you have a few more employees, there are a ton of design elements that you can implement to a retirement plan that can enhance the benefits that you're receiving as a highly compensated individual or practice owner. And that's something that often is left on the table. So really understand, hey, if I have a 401k plan, can I change the match? Yes, you can change the matching program. Can I add a profit sharing contribution element to it? Absolutely. You can weight a profit sharing contribution disproportionately to the highly compensated executives away from the rank and file. So you can add, let's say you're contributing $25,000 to your 401k plan. You can add easily another $30,000 to that with an appropriately structured profit sharing plan. and that's all tax deferred. So if you're in an income bracket, 32, 35, 37% at the federal level, this is pulling dollars out of those brackets. And typically once you get to that level, deductions are very valuable because in a lot of cases in today's tax code, you're going to be phased out of those at the personal level. So running things through the business, very efficient. Another opportunity for retirement plans, probably one that is less common, that's less utilized, something called a cash balance pension plan. Pensions at big companies are going away. Pensions at small companies are growing rapidly. So in addition to a 401k plan, I'm grossly oversimplifying this in the interest of time, but a pension plan allows business owners to put in a tremendous amount of money on a tax-deferred basis that's incredibly tax efficient. And by a tremendous amount, I mean in addition to a 401k plan, you can put up to $250,000 a year into a cash balance pension plan personally on a tax-deferred basis, if it makes sense. Obviously, you got to have some cash flow to back that up. Doesn't work for everybody, but it's something that when it does work, it works fabulously. Okay, so moving on, I want to talk about protection planning. So we talked about growth, and now we're talking about protection. And protection planning involves anything or addressing anything that could materially derail your financial plan, right? So protecting assets, protecting legacy, protecting incomes are typically the main areas. And that everyone's different, right? What they want to protect, what concerns them. So you might want to protect income, right? So that's things like disability insurance, potentially life insurance for a highly compensated individual. Obviously, property and casualty types of insurance for properties. In this cohort, particularly excess liability insurance is one that we typically see a lot of opportunity around. Whether you own buildings or rental properties, that does increase some levels of risk that you may have, so it's appropriate to have the right liability coverage. I want to talk a couple minutes about disability insurance and labor capital risk. So disability insurance, I'm sure we're all familiar with it. I'm sure when we write those checks, we all collectively groan. They're not the cheapest insurance premiums to have to pay for. But two main definitions of disability I always like to talk about: own occupation and any occupation. If you don't know the definitions in your disability policy, I highly recommend you check them. The definition is very important. Most employer-sponsored disability policies are any occupation, which means if you become disabled and you cannot perform any occupation, the policy will pay. Own occupation means if you become disabled and you cannot perform your own occupation, that's when the policy will pay. So for example, if you're an orthodontist and you're making $500,000 a year and you mangle your hand in a landscaping accident and you can't perform work for a couple of months, but you can help oversee, administer, and be an office support person making $100,000 a year. You've taken a $400,000 hit to your income and your disability policy is not going to pay out because you can perform another occupation. Own occupation would obviously say, well, you're making $400,000 less dollars. It would step in and kind of cover the percentage of the residual. So hopefully that makes sense. I like to tell everybody, go ahead and review that. Make sure you understand your limits and the definitions. Very important. Second thing, labor capital risk. That's a term not a lot of people have heard or used before. And it basically talks about the risk in the consistency of your income. So for example, if you're a 100% salaried type of employee, you have low labor capital risk. That means you get a paycheck every other Friday. It's typically about the same amount. There's not a lot of fluctuations or volatility in your take-home pay. The exact opposite side of that spectrum, if you are a commission or production-only employee, that check every 2 weeks can vary wildly. In a lot of businesses, there's seasonality. Think like realtors, or in some case, probably a lot of you, there's going to be seasonality around school schedules as to when you're busy. Everyone's trying to get kids into the dentist to have appointments during summer breaks, spring breaks, fall breaks, winter breaks, which is good. And you may have larger income checks or payments those weeks or months, but you have a high labor capital risk because you may have some quieter months, other periods of time. So it's important to plan for that. Do you need to have some extra money, some extra savings to maybe bridge some of those gaps if things are getting tight based on your spending? So those are just a couple areas I talk about from asset protection. Also from a protection perspective, estate planning, legacy planning, making sure that your legacy is protected. There's a lot of uses for trusts. We're going to talk about some of that here in a little bit. But it can help protect the legacy if you're trying to pass things on to heirs. Okay, giving. Like I said, one of the main tenets that focuses on others. Giving is a very important part of what we try to do, what you should be able to apply to your financial plan. When we're talking about estate planning, if we've gone through a financial plan, we've gone through our cash flow, and we have a reasonable expectation there's going to be material assets left over after your death, we really want to start talking about multi-generational planning. Right? Do I want to go ahead and give some of these assets away while I'm alive so that I can see the recipients use and benefit from this money, so I can see the impact of my wealth is having? Or do I want to do I want to be dead for them to receive it? Right? And those are very real conversations. A lot of times people will have beneficiaries on accounts, and they've done a very good job of accumulating, because that's what they've been reinforced for decades and decades: save, accumulate, get the bottom line to grow. And it's very hard to kind of switch the spigot the other way. And we're always trying to work with people and challenge people to find the balance between living rich and dying rich. And so sometimes when we're talking about multi-generational planning, it's, hey, do I want to give my son or my daughter X amount of dollars now so they can expand the deck on their house and have more fun with their kids, or have a bigger beach vacation, so that we can, again, impact the relationships that are important to us with time and assets that we have. Generosity and philanthropic planning, also very important. There's some very compelling tax benefits to doing that. That should not be the only reason that we're being charitable. I think it's really important, and study after study shows that people are generally happier that donate or are involved with charities. So if you have the excess capital and the ability and the time to do that, we think it's a great use of your time and your assets. And there are some very compelling strategies that you can use for giving money away, and again, making a bigger impact in your community about causes that maybe you're passionate about. In the interest of time, I will speed up. Live, this is the fun part. This is where we get to spend it. So cash flow analysis is very important. Understanding how much you have, how much money is coming in, and how much money needs to go out is vital. Most financial planning decisions can be boiled down to very quantitative analysis around cash flow, and not as much qualitative analysis around something like risk tolerance. So when we talk about risk tolerance or portfolio construction, if I give people risk tolerance questionnaires, you're going to answer those questions differently dependent on probably what just happened in the stock market. Last couple of days, market hasn't been doing well. If I give that to you right now, you're going to have more negative answers than positive answers. And if the market's been up for a month and a half, you're going to think, hey, I can take a lot of risk, right? That's an impossible mandate to try and manage a portfolio to. I think it's much easier to focus on how much do you need off of your portfolio on an annual basis, so that we can kind of build out how much we're comfortable spending, right? We can have assets allocated to grow. We can have uncorrelated assets that will help supplement cash flow over a multi-year period, so that we can make sure all those assets and all that money is there for you to be able to spend, right? Making sure that we're accounting for one-off items. A common item when we do cash flow projections that people miss: automobiles, right? Everybody says, hey, I spend $10,000 a month, so it's $120,000 a year. That's great, but every 5 years we're gonna have to buy a $60,000 or $70,000 car. That will have an impact on cash flow, right? Whether you pay for it or finance it, it's an expense. Breaking out things like travel budgets, mortgage amounts, and really understanding your numbers at a granular level will allow you to have the comfort to be able to spend what's appropriate or what you can, and live hopefully a fulfilling life. Couple other things that I want to kind of talk about. Common strategies that you probably haven't heard of. I'll focus on DAFs and pass-through entities. So donor-advised funds, kind of in the vein of charitable giving. A lot of people haven't heard of those. Incredibly useful tools. Think of them as a charitable savings account. So what you can do is you can put stocks, bonds, cash, in some cases private shares of a business, into this charitable savings account. You get an immediate tax deduction on the value that goes into this charitable savings account. And the advantage to the donor advised fund is that you can distribute those assets or those dollars out over time. So the planning element here is, if you have a year where you have a spike in income, like a business sale, a property sale, maybe the stock market's just way up and you realized a lot of gains, you can pull forward years of charitable giving, or at least pull forward the tax benefit of years of charitable giving and focus that into one tax year so you can maximize your benefit. And that's something that I think is really powerful. Second thing for the practice owners out there, state-specific pass-through entity taxes. 2017 Tax Cuts and Jobs Act put limitations, or the SALT limitations on income of about $10,000. The OBA, or One Big Beautiful Bill Act, adjusted that, lifted those SALT deductions, but also introduced phase-outs. So the moral of the story is you may be able to pay state level or state-specific taxes through your business as a business expense and get around the personal income deduction limitations on your personal tax return. So it's state-specific. North Carolina definitely does that. If you're in another state, check with your CPA. But that's definitely something where if you're in a higher income tax bracket, that can be extremely valuable. Missed opportunities that we see on a somewhat regular basis. I always like to talk about these. Not taking advantage of tax saving strategies before, during, or after a sale or a transaction. Not taking advantage of retirement plans. I think one of the more common ones that we run into is around a transaction, not having a great grasp on gross versus net. So, just so we're all on the same page, if you sell your practice for $5 million, you're probably not going to get to keep $5 million, right? Your favorite uncle is going to be involved in that transaction. And so just really making sure that you have an understanding of how much you're going to keep and using that number. It's very easy psychologically to anchor to, I'm going to get a wire for $5 million. I have $5 million. I'm going to plan on having $5 million. Having $3.5 million net is going to be a very different planning circumstance than having 5. And that's okay. We just need to make sure we plan for that. So that's something that does come up somewhat frequently that we like to talk about. And then also building the right team. When we're talking about something like a transaction, don't use your cousin, the CPA, to help you with M&A. Don't have your neighbor that's an attorney help with the business side. Find a specialist, hopefully one that works in your industry with M&A, tax, and then also making sure that's all coordinated with your financial plan and your wealth plan. Because when you coordinate, let's say, the particulars of a transaction in your plan, it allows you to pick the best option, which is not always going to be the highest number, right? So if you take the highest number, in some cases there's going to be terms on the back end that are less favorable or maybe don't align with where you're trying to go. And so in some cases, taking a bid that's maybe slightly lower but more flexible or more in alignment with you will probably be better long term. So with that, I'm going to stop. I'm going to open things up for questions, comments, concerns. Explained everything perfectly.
Now let's see how well you can putt.
Not good. Thank you.